What I want to discuss with you are some very worrying charts, specifically for the US economy. We know that if the US economy is in trouble, most other economies are in trouble. And I want to share these with you because I think it's really important to be fully aware of the other side of the coin. I know it's great to be, hey, we're going to be long term bullish and all that great stuff. Fantastic. But what about short term volatility? Things that could be happening over the next few months, 6 months, maybe, for example, that could really, really shake markets to their core. What are some indicators or statistics or data that are showing we could still have some turbulence ahead and you might want to keep your seatbelts fastened? Goldman Sachs, again, big banks, not a big fan, but Goldman Sachs out here warning there's a 20% chance of a US recession in the next 12 months. JP Morgan, of course, they came out recently and said basically no chance of a recession now. Can't really trust these big banks as far as you can throw them. They're pretty damn big, so you can't really throw them very far. Still, though, we've seen a general consensus towards this. Well, not really much of a chance of recession anymore. Not a big deal, kind of coming out recently. So most major financial firms and analysts are kind of moving in this direction. But are they right? What's the data saying? Well, Joe Consorti over here on X shared, well, the Fed is done hiking. That's his opinion. Fed, of course, not has officially announced that, but based on this, because it always pauses when the unemployment rate rises off of its cycle bottom. Unemployment kicked up to a 3-year high of 3.8%. That was last week. The Fed's goal to loosen the labor market is finally taking shape. The question is, how long can it hold before it cuts? How much more unemployment does the Fed want to cause? If you really think about the interest rate hike thing, the Fed's basically done everything it wanted to do, right? Inflation's largely been tamed. Unemployment's finally going up. They broke some banks, some other stuff. But it's pretty interesting that we are finally starting to see unemployment going up. Now, the question, of course, is how high will the unemployment rate go? How long will the Fed stick to their guns? And I know that there's often this thought, well, they're not going to let the economy tank in an election year. Well, they've often let the economy tank in the election year. Sometimes they can't help it. 2020, election year, economy tanked. 2008, that was a pretty big tank of the economy during an election year. 2000, that was an election year. Economy tanked pretty good in that year too, didn't they? So certainly can happen. Obviously, it's not a great look for the incumbent in that situation. Still, though, unemployment is on the rise. So perhaps that gives the Fed a bit of fuel to say, maybe we can pause. Maybe we can pause now. Bar chart here pointing out that the Fed fund rate versus US job openings indicates the Fed may be done raising rates again. So whenever we see the unemployed numbers starting to dip, we tend to see the interest rates either flatten or start coming down. Now, this was true in 2006, where we had interest rates up around 5%, 2006, 2008, around 5%. When the unemployment number peaked a little over 2%, the Fed started cutting. Similar situation in 2020 as well. So, will that be the case this time? This could be our best leading indicator that we could see the Fed funds finally coming down, the interest rates finally coming down. So we'll see. Game of Trades here pointing out the stock market's bottom after the unemployment rate significantly rises. Now, the question is, what will a significant rise be? Because currently, let's keep it real, currently, we have not seen a significant rise in the unemployment rate, right? The unemployment rate currently is like 3%, 3.8%, right? Almost 4%. We're not at a 10% unemployment rate or an 8% unemployment rate, and that could still happen. That could still happen. We haven't seen a significant rise yet, a massive spike in unemployment. That could happen later on if, of course, we get a recession. But definitely the unemployment going up is going to be worrying markets a little bit, although could be comforting to the Fed. Also want to point out this because I often see that, well, look, the Fed fund rate is high right now, and it doesn't mean, and it means basically that markets aren't going to pump. It's not necessarily true. Now, currently, about 5.5%, 5.25 to 5.5% for the interest rates. Now, last time they were this high was back in 2006, 2008. And I think, oh, 2008, that's bad. That's a bad year, right? Yes, 2008 was a terrible year. However, what's interesting here is that the interest rates stayed basically flat at about 5.5% for over a year. And during that time, the S&P 500 rallied 31% approximately. That's pretty interesting. Do we have another example when the interest rates were really high and markets went crazy? Yes, we do. In fact, a very interesting one. You see, if we go back to 1995. Oh, 1995. Those are good times, weren't they? Ah, the 90s. The music was great. Ah, man. We didn't even really have internet barely yet. Those are crazy times. I feel like it's a special time. The last years before the internet revolution really took off. Anyway, that is why it was such an interesting time from a economic perspective, because while the interest rates remained around 5% from 95 all the way up until 2005 years. For 5 years, the Federal Reserve kept the interest rates around 5%. And guess what happened to the markets during that time? The S&P 500 went up 245%. Of course, that was the dot-com bubble, very famously. But still, that meant a massive market rally was possible in that high interest rate situation. Now, look, nothing's ever the same. Things are always different. I know. Yeah, speaking of the 90s, Crimson Caravan here in the chat. I remember waiting for over an hour for a Playboy centerfold to load on, on dial-up internet speed. He says I got caught before it was finished loading. Lark, what are you doing in there? Mom, it's not what you think, I swear. Yeah, those were the days. Mom's Victoria's Secret magazine. You guys know what's up. Anyway, I seriously digress there. Okay, so before we get into the rest of the data, if you're not yet signed up for the Wealth Mastery newsletter, you gotta check it out. It is the best cryptocurrency newsletter. Every single issue just super jam-packed, full of value for you. We talk about NFTs, we talk about DeFi, we talk about altcoins, all kinds of alpha on altcoins, all kind of news on altcoins, what's happening in the cryptocurrency space, alpha on airdrops, and much, much more. You can sign up for free and join our 75,000 weekly readers by clicking on the link in the description, or you can go to thewealthmastery.io to get signed up. Okay, let's dive into some more data here. So, this is from the Kabezi letter. Personal savings in the US peaked at $2.1 trillion during the pandemic. They have fallen sharply since. Now, there are about $190 billion in personal savings remaining, down 91% from the peak. People have been spending their money. They've been spending their money during times of high inflation. Since 2020, household savings have declined by $100 billion per month. At the same time, of course, we've seen credit card debt absolutely exploding. And as the Kabezi guys are pointing out here, debt levels are going to soar. Well, that's exactly right. When they run out of money, people are going to turn to the credit cards. So we've seen savings go from 2 trillion down 190 billion. And if the current rates of consumption continue, then by end of October, sometime November, people are broke. The savings are gone. All they have left then is credit cards. Of course, when your back's against the wall and all you have left is 20,000 bucks on your credit card, what do? You buy dog coins and you gamble. It's either Valhalla or nothing. I hope don't gamble your last $20,000 away on dog coins, guys. Come on, let's keep it responsible around here. Bar chart pointing out a report from Fidelity. So Fidelity International saying that a wall of corporate debt could spark the recession in 2024. The problem is that over the next 6 months, we're going to see a massive amount of refinancing of a huge amount of corporate debt. Now that means that all these companies are suddenly going to have much bigger interest payments. So not only can they not borrow cheap money anymore, but now the money that they borrowed is going to cost them a lot more, meaning that they're going to have to try to repay that quicker, or they're simply going to have much bigger burdens financially, which means they're going to hire less people, they're going to fire more people, they're going to have less sales because other companies aren't buying as much stuff from them. The consumers are all broke. It's a real problem. This starts to become a lot of factors coming together that could signal a coming slowdown. And look, I don't know what the answer's going to be. We live in interesting times of monetary policy where the central banks can just print crazy amounts of money and kind of erase all this stuff that normally would probably really, really matter. And it could still really, really matter if they let it matter. Maybe the Fed's happy with as much breaking as they've done and they'll kind of chill out. Maybe they want to break some more stuff and they let all this stuff just keep running until things really, really break. And you lose your house and you lose your job and you lose your dog and you lose your car and you become a fentanyl zombie. Sounds dark, but that's kind of like their plan for you. Don't do it. Don't do it, guys. Beasley letter here also pointing out about inflation. So inflation has gone up a little bit. Obviously, we bottomed recently at 3% and popped back up 3.2. Expectations now for 3.3%. So that means the inflation battle continues. So problematically, we see unemployment going up, which could signal to the Fed maybe it's time to chill out. But then inflation starts rearing its head again, and the Fed goes, maybe we should do some more rate hikes. We haven't broken things enough. Let's break things some more. So there's a real battle here between will they, won't they, in the direction that they're going to choose. Unusual Whales pointing out the Federal Reserve has issued a slew of private warnings to lenders with assets of between 100 to 250 billion, including Citizens Financial Group, Fifth Third Bank Corp, M&T Bank, and others. It's demanding that regional lenders increase their liquidity planning. Now, that doesn't sound like a very... You should increase your liquidity planning. Doesn't sound that scary, does it? No. That's kind of a scary statement because that means that the Federal Reserve is worried. Let's say, I'm not going to say they're panicking or freaking out, but they're definitely worried. They're issuing warnings. They're saying, hey, guys, there's a problem here. Watch out. We could see more banks coming down with these high interest rates. Remember, they just wanted you to lose your job in your home. A kind of a side effect of them doing that has been the collapse of all these banks around America, and it could get worse with this high interest rates. Now, hopefully, of course, their facility that they set up to let banks access liquidity is going to be enough to provide the liquidity here, but still, they're making warnings, and that warning should warn us that something's going on. Then, of course, there's China. China always out there causing problems. It's China again. Always the same damn people, isn't it? It's always the Fed. It's always China. What are these guys doing? Always causing all the problems. Now, we covered this in more depth recently, but just to reiterate some of the key things, over the last month, we've seen China cutting rates. We've seen China removing 50% of their stock trading tax. We've seen them basically trying to make it illegal to short stocks. We've seen them lowering rates on $5.3 trillion of mortgages for the first time since 2008. There's that 2008 number again. That's not the year you want to compare anything to. No. When you want to make comparisons about financial data, 2008 does not want to be the reference point because that's a bad reference point. HY's real estate index down 82% in 2 years. Banks cutting deposit rates for the third time this year. Of course, Evergrande went into bankruptcy, all that kind of stuff. China's central bank, lowering interest rates on existing mortgages, meaning that they're trying to give regular people a bit of easing, so to speak, and they're lowering down payments needed for the first and second time home buyers, which means the Chinese government wants people to come and speculate. They say, hey, you don't even need as big of a down payment anymore. Bring it, got 2%. That's cool, man. Bring it. I don't know what the exact number is, but it's less. And that's interesting because they're really, really trying to stimulate that local investment market where they want people to start speculating on properties and stuff again and push markets back up, push economic activity back up, because then people will have more of a wealth effect as property prices rise, et cetera, et cetera. Becomes a positive cycle for them. And of course, one thing we keep coming back around to is that damn yield curve. So this is, as they say, the classic recession indicator. Well, it's at its lowest level since 1981, which generally means everything's going to be terrible and a horrific recession's coming, and pray now because it's going to be bad. However, the European Central Bank kind of let the cat out of the bag on this one, which makes all of this stuff, because again, previously seeing all these things and say, well, that's most likely what's going to happen. Now, I don't feel like it's so certain. And maybe I'm being overly biased. Maybe I'm just totally wrong on this situation. Of course, you can let me know that down in the comment section. But I feel like because of the central banks printing money, things have changed. And the European Central Bank basically lining up on that statement. The European Central Bank said the yield curve may be less able to predict recessions because of the market distortions caused by central bank bond buying. But of course it does. And of course, when it comes to like recessions in the USA, for example, technically the USA had a recession early last year. Technically. But technicals don't matter anymore. Because now recessions come down to a small group of people who kind of look at, well, maybe this sort of that, the other thing, and we'll decide when there's a recession. So it's not as easy anymore just saying, well, that's a recession. That's not a recession, because they've outsourced it to some small group of political insiders who will let you know when the recession is. And probably by the time they tell there's a recession, it will have been long past already. Ottavio over here pointing out that we are seeing the widest spread right now between mortgage rates and 30-year risk-free rates, which is pretty interesting. Last time we experienced cyclically large spreads. Again, lots of years you don't want to be associated with. That's the dot-com bubble, the global financial crisis of 2008, the pandemic of 2020, and now. And now's the worst. It's the worst it's ever been. Interesting. Again, too many things comparing us to things you really don't want to be compared to. Game of Trades here pointing out soft landing narrative is now the consensus. And if the crowd's always wrong, then the soft landing might be wrong. We might be coming in for a very hard landing. Now, the soft landing consensus. So this is basically news story counts on soft landings. So we had this actually back in 2000, where we had about 18,000 news stories saying, well, soft landing's coming. It's all going to be cool. Back in 2006, we also had lots of soft landing stories. Once again, lots of soft landing stories. But what was not true in 2000 was it didn't have the massive money printing. 2006, the money printing hadn't started yet. Now we have massive money printing. Maybe they're really able to pull it off this time. It's hard to know where the truth is with this economic data, because everything's been so distorted by the central bank money printing. Unprecedented money printing, remember. This is not just a little bit of money printing. No, this is like crazy money printing. And they haven't been printing money very hard recently, but they will. Whenever there's a crisis, you can count on central banks to print money like crazy, because it's basically all the tools they have